eWealth Partners is an investment advisor registered with the SEC. The information in this podcast is educational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. Determine what strategies or investments may be suitable for you and consult the appropriate qualified professionals prior to making a final decision. Okay, well, today's guests, we have the one and only Dyanne Ross-Hanson, President and CEO of Exit Planning Strategies. Dyanne, first of all, welcome to the show.
Thank you, Brian. It is my pleasure to be here with you today.
And today we get to cover the topic of the 7-step process, the foundation for comprehensive exit planning. Now, let's start here. Tell me the difference. What is exit planning and how is that different than succession planning?
Yeah, I actually get that question a lot because truly the two are separate. And how I like to generally describe the differences is that when an owner or a company thinks about succession planning, that's really a focus more on who will take over leadership of the business. Whereas the exit planning, if you will, focuses more on how and when an owner is going to transition out of ownership and convert their business into personal financial security. I call it monetizing their business. So the succession is more on the leadership, who's going to lead going forward, whereas exit planning is really taking the owner out of ownership and converting it.
Right. And I like how you said in a previous conversation too, that succession might be more of the, like you said, leadership and even kind of the softer skill side of what that looks like, where the work that you do is very technical in nature. Is that fair?
Yep. Yeah, I always, and we'll get into this, I'm sure, as we continue to discuss, but there's so many aspects that a business owner really does need to address in this process. From the psychological standpoint, that's huge, both during as well
Yep.
as after, to, who they want to try to transition to, if we forgot about money for a moment.
Sure.
My work, as I describe it best in the industry, is more from a tactical and clearly a financial stance on
Okay.
helping the owner to develop a comprehensive plan. Yep.
Okay. Well, let's talk through that. So let's take us through what is
Yep.
the 7-step process? What does it look like? And let's talk through the steps.
Yep, which is my favorite subject for sure. And I have to begin the conversation, Brian, with attributing those 7 steps to the founder, and that is Business Enterprise Institute out of Denver, Colorado. I discovered this 7-step, gosh, 20 plus years ago. And given my background in the financial industry, this really did resonate with me. So these 7 steps are part of the business enterprise offering, if you will. And what it did is it offered a process to help me help business owners take control of what, in my opinion, is going to be the most significant financial transaction of their lives, and that is monetizing their business, exiting their business. And I know we're not looking at a visual, so we're going through it verbally. So I'm going to apologize in advance for the word usage, but I will say it's outcome agnostic, it's multidisciplinary in nature, the goal of which is to help me direct a defined process for not only the
Sure.
owner, but for their advisory team. Because what you'll hear is that this process absolutely is a multi-professional approach.
Sure.
Your expertise is necessary, CPA's expertise,
Yeah.
legal, all of that. Okay, so briefly, step 1, which step 1 is the most difficult for many
Okay.
owners, and it's the most time consuming as well. I will throw that in
Okay.
because it identifies what's your goals. And the goals that I ask is how much, and you'll see this is very financial, tactical based. First question is, how much income, how much capital do you as an owner need in order to enjoy what you define as financial independence? Now that
Sure.
differs. And again, in your work with clients,
Yeah.
that differs. And you and I, we're not making judgment. We're just simply asking, what is it that the capital is going to take? The second part of that is, who would you ideally like to transition to? If we forgot about the money for a moment, is it an internal buyer? Is it a family member? Is it going to the market?
Mm-hmm.
So how much capital do you need? Who would you like to transition to? And then the third is, when are you looking to depart? Either in time, in capital, or both. So we start there. And
Interesting.
that starts the foundation. When do you want to be out? Who do you want to transition to? How much capital do you need? Step two is, what are the financial resources available to you? And that certainly does include the business. For most owners, their business represents a pretty significant portion of their net worth. Now, it's not what do you think it's worth, but
Yeah.
what is the company worth? Because every owner, as you know, has probably an opinion.
Uh-huh.
But gaining an outside, it doesn't have to be an appraisal. It doesn't even have to be a certified valuation, but some
Sure.
sort of outside opinion. And in fact, I think, don't you, Brian? I think at eWealth do offer a calculation software to business owners if they're interested. I know I utilize that as well. But
Yeah, yeah, no, yeah, we do as well. So it's kind of like I like to say in some ways it's a the TurboTax version of business
yep,
valuation. It gives us
yep,
a starting point, and we can put in the financials to start. Like when we do the financial planning, like as you said, one of their typically their biggest asset is the business. So let's use
right.
some type of software. We have a better understanding what the true valuation is.
Yep. And you have to have that. I think in order to begin planning, we have to have an opinion, even if it is a calculation. So step one is, when do you want to be out? Step two are, what are the financial resources available to you? Step three in this 7-step process is, how do we build value? If we determine we have a capital need, now we've identified the financial resources. Is there a gap?
Okay,
If there's a gap, step three says, how do we bridge that gap? How do we add value to the enterprise, as well as minimize Uncle Sam's take? Or, you're not going to minimize it totally, but how do we minimize taxes on whatever chosen strategy you have? That's step three. My one little piece of expertise in value acceleration, that I work with a lot of owners just even independently as a standalone, is key employee incentive and retention plans. When we look
okay,
at value drivers, all
yeah,
kinds of them, low debt, growth strategy, recurring revenue, diversified customer base, all of those wonderful value drivers. In my opinion, having a motivated, qualified bench team person in your leadership, other than the owner, is probably the single most important value driver. So how do we build compensation to
sure.
attract them, to retain them, to reward them? That's a piece of that step three, which again, maybe at some point, Brian, you and I can have that conversation, because I always say every single business should be focusing on
Hmm.
training, supporting, and most importantly, compensating in such a way that they're thinking like owners. They're sharing in value. But we'll save that. We'll save
Yeah,
that for
and
another
before we
day.
move on, because I think that is a very interesting topic, and we can talk probably do a whole new podcast on that as
Mm-hmm.
well. But just because you want to align the incentives, both for the company and for that lead rep, and how do you do that in a way that moves the business forward and can also reward that employee too, right? And so I understand like how you say, like, is there a gap? And one of the great ways to kind of move towards that, that end target is making sure that we're compensating those key employees correctly. I'm
Absolutely.
sure there's other stuff too around that gap, but that's,
Yep.
I think we all understand there's some main players in the business, and if we can create incentives that we can
Yep.
all move the business forward. So
And you know what the biggest um the biggest mistake that most owners make when it comes to building out incentive for their key personnel?
What? No, tell me.
They make it outright.
Oh, okay.
They make it outright versus having some of that compensation held back, deferred until a
Sure.
future payout. Otherwise, there's no retention. That's the biggest mistake owners make is they take the time to develop it. That's great. But if unless the owner is retaining some of that for future payout, no retention.
Got
Anyway,
it.
what are the objectives? What are the financial resources? How do we build value if we need to? Step 4 is an outside transaction, which is absolutely an option for each and every owner. If the owner is saying, nope, you know what? I'm just building this to the point where I'm going to go out to the market, try to get maximum dollar. Wonderful. If that's your plan, my suggestion there is that, meet with an investment banker, transaction intermediary, business broker, depending upon the
Sure.
size of the business, at least a year prior to wanting to go to market, just to get the company ready. And the one thing that I'll say on the step 4, which is an outside transaction, is that there's nothing more valuable in that process than competitive pressure. And what I mean
Okay.
by that is having duplicate potential interested parties, competitive pressure. I have a very valuable colleague, an investment banker. That's what he calls it. And I think that's fabulous. So, step 4, outside. And quite frankly, if the owner's trying to maximize value, that's where they're going to find it.
Yeah, I mean, it is value, price, transaction, maximize what you can get for the business. We could probably say it a
Yeah.
thousand different ways.
Yeah.
But so if someone comes to you and they originally say, no, my original goal or my ideal goal is to transfer, and I get that you said we're outcome agnostic, and they say,
Yep.
I really like would to turn it over to my key employee or,
Yep.
my child in the business or not even in the business. And then you still encourage them to go and just like basically, what would it be if you brought it to the marketplace, right? Through an
Absolutely.
investment banker, a business broker, whatever it might be. Why? And tell me through your experience, why is that helpful? And what does the business owner learn from that experience?
Yep. You mean by taking it to an outside market
Yeah,
sale?
just seeing what
Oh,
that
yeah.
looks like.
It's
It
big.
wasn't my number one, kind
Yep.
of like, goal, but like, hey, this opened my eyes or that was
Yep.
interesting or yeah. Any stories or
I,
experiences?
I think the greatest thing that an owner will probably learn in that process are value drivers for their business, their enterprise that impacts them both positively as
Sure.
well as negatively. They'll
Sure.
learn that in a quick heartbeat.
Sure.
Um, I think that's the biggest. They'll also learn, Brian, in my experience, whether or not they're serious. If you talk to intermediaries, there's all these statistics out there that say that, only 30% of businesses that go to market end up in a successful sale. A large part of that is because of the seller, the mentality. They're either not
Interesting.
happy with the price, they're not psychologically ready to give up their baby yet, or
Mm-hmm.
they think that they're going to get a pot full of cash and ride off into the sunset. That's very rare. Depending upon the industry,
Sure.
there's a lot of the purchase price that may be in portion and an earnout. They may have an employment contract where they've got to stick around. So
Mm-hmm.
they, to answer your question succinctly, I think owners understand and learn value drivers and deal terms where they had no clue prior,
Yeah, sure.
you know, thinking, well,
That,
I'm just
that
going to sell it. I'll take cash, I'll leave, I'll, go to the beach and put my feet up. That doesn't happen a lot. There's
yeah.
very few all cash, no retainer type of sales.
And that could be a whole nother episode too.
Right,
Um,
right,
all
right.
right.
All right.
So that's
So,
number 4.
yep, step
What's
5 of the 7 is my favorite. It's not, I should say it's my favorite, but it's also where I do share my greatest expertise, and that is on internal transitions. That can
okay?
be co-owners, it can be family members, it can be key employees, it can be any combination of the above. There's one major challenge to initiate and to go through with an internal transition. And what do you imagine that that might be?
I think I've heard it, and I'm pretty sure they just can't do it financially. They need some help
Correct.
from the seller.
They don't have money.
Yeah.
Your internal buyers, whether it's a co-owner, family member, key employees, rarely come to the transaction with a boatload of cash. So the reality is we're either going to have to potentially discount the purchase price to make it a bit more affordable, or the owner has to understand that some portion of this transaction, not all, shouldn't be all, but some portion of that transaction is going to be seller financed. Now, what does that mean? It basically means that some percentage of that transaction is going to be financed through cash flow from the business that hopefully the successors are responsible for generating, maintaining, or increasing. That's basically how an internal transition is done. Rarely, and again, a lump sum, rather over time. And some of
Right.
that is coming from profitability that they are generating on behalf of the owner within the business. Does that make sense?
Yeah, that makes sense. Basically, the seller just you're gonna, in some sense, play bank and say, well, they owe you, and then hopefully, if you send this over, transfer this over to that key employee, you're comfortable with that risk. That
Yep.
like, hey, if you keep running this right, it should generate the profits and the cash flows that you
Right.
need to pay me for the business. So,
Right.
yeah, that makes sense.
Well, and two, the other thing is that once your successors, and I'll just say it's key employees, let's say once your successors have utilized that profitability, or ideally increase in profitability, to gradually buy ownership within the company. Once they're at a 20-25% ownership, now they're bankable. Now they
Sure,
can go to a bank or an
sure.
SBA. Without any ownership, they're not even bankable. And that's why very rarely is it going to be financed by those successors, at least initially. And in fact, in my opinion, when the owner has a properly structured incentive-based plan for
Hmm.
that key personnel, ideally that deferred portion of that plan is what is then used
Yeah,
to begin purchasing stock gradually. And then only when the owner decides that, yes, this is going to work, these people are totally capable of leading this company, it's only then that the owner would ever relinquish more than the 51% that they should be holding on to until they're certain. So internal transitions, can they work? Absolutely they can. And owners will look at that for a number of reasons. Maybe they've promised their people that, hey, you've helped me build this, I want you to take over it. I will say that if the owner is saying my goal and my exit plan is to absolutely maximize my cash, it's not going to be from an internal transition. We
yeah,
just talked about that. It's going to be from that
yeah.
external. But internal transitions absolutely can work. They're going to take more time. Sometimes I'm
Sure,
asked how long. 3 to 5 to 7 years, really.
sure.
It's not an immediate exit. And a lot of times that's okay because the owner really is required to kind of help mentor if they haven't already.
When you
So,
see the internal
yeah, yeah,
transitions, transfers, how often, what percentage of those are to a family member? Just
yeah.
from your experience,
You
about
know,
half of them, more or less?
engaged by a family business to develop a transition plan. I
Hmm.
would say close to 95% of them,
Sure,
family businesses, are trying to keep the company within the family. Now,
sure,
that has some unique planning issues all by itself. Is it equal to active and inactive? Is it at full
sure.
price? Is it a gifting? Is it a sale? Are the successors or family members qualified? Or should
Hmm.
we be looking for external professional leadership? We still want to hang on to equity, but we can't do it with the talent of our next generation. That's,
Sure.
all kinds of fun issues on family. So if a family business is hiring me, I would say 95%. Now, having said that, 2 years ago, I was working with a family who was on generation three, looking to go to generation four. And we spent quite a bit of time of, evaluating options, laying it out on paper, presented it to the next generation, generation four. And the generation four, there was three of them. And they just kind of looked at their parent, who was my client, and they said, Dad, we're not interested in stepping into and
Mhm.
doing what we've watched you do for the last
Mhm.
20 or 25 years. Not,
Mhm.
not, not what we had in mind. And so they ended up going to the marketplace. And that's happened a number of times for me, where
Mhm.
family business, they start out wanting to try to stay internal and through the process determine that no, an external sale is what's going to work. So
Yeah, and I think it's
anyway,
that the going through that process. I mean, you got to figure it out. I think that's completely fair
absolutely.
for the from the children, like to say, you know what? No, this isn't something. But now they know, right? And now they know,
Yep.
okay, if it's not going to be that internal, like this
Yep.
process will take you through of kind of again, I'm going to keep going back. I love how you said it's like outcome agnostic. It's just going
Yes.
through the process, and then that helps them solidify what their
Absolutely.
end goal is. So that was number five.
Yep.
We move on to number six.
Step six of seven is the business continuity, the backup. This isn't one of the ones that most owners want to talk about, but it's absolutely critical. And by the way, probably the easiest component of the seven. Business backup, business continuity. What happens if a triggering event, an unexpected, let's say death, disability, what happens if that happens before plan is
Mm-hmm.
developed for ownership transition? Most often it's surrounded around, having shareholders agreement that will
Mm-hmm.
stipulate, what happens to the stock in the event of a triggering event, which by the way, not only death, disability, could be divorce, could be
Yeah.
partner disagreement, all kinds of potential triggering events. What's the backup plan? Is it established? Is it in writing? Is it current? And certainly in the event of death, is it funded in the
Mm-hmm.
event of a death? And if it's funded, is it properly? There again, this is a subject, Brian,
And
that
what
we
it
could again do a whole
right and
podcast on.
because
And there's,
when you
yeah,
say funded, share a little bit
funded.
more. Is that do they have the money to buy the shares from the other part, the
Right, right,
deceased
right.
party?
And
And how are you doing that typically? And that isn't that typically done through like
life
life
insurance.
insurance,
Everybody's
is
favorite subject. Everybody's favorite
yeah,
subject, life insurance, right?
yeah.
It's so simple because, again, if let's say you and I are in business, we're 50-50 or whatever.
Uh-huh.
If we're in business, we should have a shareholders agreement that says, you know what, if something happens to me,
Mm-hmm.
you are going to have the first right to purchase my ownership.
Mm-hmm.
Um, because even though you like my husband, you appreciate him, you're
Mm-hmm.
not interested in being in business with him. So that's the first
Mm-hmm.
step. Now the question is, if we've been successful, Brian, and we've built a business that's worth 10 million and you
Yeah.
have the first right to purchase my interest, you now have to come up with 5 million. Now you may
Yeah.
have that in your checking account. Chances are you
Yeah.
could. most
Right?
people
Yeah. No.
most people don't have that type of capital. So here's how it's funded. You and I own a life insurance policy insuring each other, and I own it in on the policy insuring you. And vice versa. You own the policy insuring me for 5 million. I die, that 5 million goes to you.
Mm-hmm.
You now have that cash capital, which by the way is received tax free,
Yeah.
and now you turn that 5 million, not, you can't say, hey, this is really nice, I think I'll keep the 5
Yeah.
million. By terms of the document, you have to turn that over to my family. My family, by terms of the document, have to turn my 50% ownership over to you. Now you're 100% owner. And that's how simple it can be. And quite frankly, if you and I are in decent health, even aged, the insurance funding on buy sell agreements is so economical,
It
typically.
is. It
Totally
is.
economical compared to you borrowing 5 million. Imagine you're going
Mm-hmm.
to borrow 5 million plus you're going to pay interest.
Mm-hmm.
So it's
Yeah,
costing
and
you 5 million plus. It's crazy.
right.
Anyway,
And
so
we're going through that, John and I as business partners and going, and it is, and you just like it's so economical to carry some policies just
yes,
in the what if, right? And then
yes,
right, because John would say this, and I was like, we yes, and even part of our operating agreement is the surviving spouse can't plug into the
correct.
existing business, so pay them out. So
Right,
when you say funded, it is I don't know. I want to say it's simpler than we probably it's not as complex as we think it is, right? And
right.
so, and
Doesn't
you
need to
don't even
be.
have to, you don't even, as you know, you don't have to have a business partner in the business. It could be someone, as far as who would take that over.
Absolutely.
But
The last step is the estate planning. And I'm just going to, mention identifying objectives, determining the value, building value, sale to an outside, sale to an inside, business continuity, and finally we come up with estate planning. And what that one is, what that final step is, Brian, is really just making sure that the owner's overall estate plan, their wills, their trusts, their inheritance plans are in sync with what their plans are for the business. Now,
mhm,
again, in that section, we can do analysis of their existing documents and try to make suggestion. That's where the estate planning attorney is a critical member of the advisory team. So again, in a nutshell, this 7-step process is really meant to educate the owner, to determine what's realistic as far as options, and lastly, to coordinate the efforts of a multidisciplinary advisory team, minimum of a CPA at the table, a corporate and an estate planning attorney, myself, the financial advisor. I mean, we could add, but at minimum, the CPA, the attorney, and myself, multidimensional. And that's the foundation.
yeah, and back to the estate planning piece, something that is important, and I'd say any good wealth advisor, financial planner, financial advisor, they should be doing the estate
Yeah,
planning. Now, yeah, we're not attorneys, we're not writing the legal documents, but to understand how it integrates into their financial plan, where we work together, Diane, on a couple of joint, basically
mm-hmm,
exit plans with some of
mm-hmm,
our business owner clients and vice versa, is also understanding the estate tax. So
yep,
just on the Minnesota side here in Minnesota, but also on the federal side, we have software and the tools and resources here to actually say, all right, well, what if we did, die
yep,
here and our current plan to actually say, okay, this is what we would be paying in estate tax, and let's create some strategies around that to help minimize the estate tax. And so
absolutely. That's huge.
yeah, and maybe that would be just a kind of a shout out too, because we have done joint work
Yep,
where let's go back to the BEI and the exit plan. So because I took that full course and it was
yep,
incredibly comprehensive,
yep,
and I think I know more than most wealth advisors about the exit planning piece of it. But what I realized when someone actually found me through that network to help on the exit planning was like it's I do as a wealth advisor that I understand that process, but what I
yep,
walked away with is you really have to do this as your full-time gig, right?
yep,
This whole exit planning
absolutely.
piece of it. And so let's come back to the 7 steps in just a second here, but maybe just shed some light on that because there are so many, really, they're financial advisors for the most part. There's other consultants, but we're calling ourselves exit planners, right? But you've been doing this like I feel like you're like
And
the local celebrity in town doing exit planning for what 100 years or something like that. How long has it been?
ouch.
Yeah. I'm kidding. I'm
Oh,
kidding.
no, no,
But
no.
you've been doing it
You know,
for a long time, right?
absolutely. I started exit planning, believe it or not, back in 2005. So
Yeah.
it's been 20 years, and boy, what a difference the landscape has been. When I started exit planning strategies, it was like, what's exit planning all about? Well, today, as you just mentioned, it seems as though certified exit planning advisors, CEPAs, they're multiplying like the rabbits in my backyard.
Well said.
And while that certification is absolutely valuable, in my opinion, I think it adds an element certainly to a advisor's expertise. But the difference that my process and exit planning strategies really does offer is that, just like you had said, it's outcome agnostic. It's multidisciplinary by nature. Outcome agnostic, meaning I'm not looking for assets under management per se. I'm not
Yep.
looking to sell the business. If they decide they want to take it to the outside market, I bring in a colleague. Just like, how much capital do you need? I'm not necessarily going to identify that. It's going to be the owner's financial advisor or wealth manager that's
Mm-hmm.
got to be at the table to answer that. But, so I think when it comes to offering resources in directing a disciplined process that is focused on developing a written action checklist and plan on paper, I have not, Brian, ran into anyone in this
Mm-hmm.
space that offers that level of objectivity and expertise. Remember, I can't do it by myself. Absolutely not. I could
Yeah.
not do it. But the difference is that when I work with a client, I'm engaged under an engagement fee. I don't have an ulterior motive. I don't mean to say ulterior motive, but this is an area of expertise.
Mm-hmm.
And yes, it was developed really to be able to, quite frankly, move away from any potential conflict of interest. And I think
Mm-hmm.
that's probably the biggest thing. And to
Mm-hmm.
develop a level of expertise that, quite frankly, the CPA isn't going to have, the attorney isn't going to have.
Sure.
So again, yeah, owner-centric, outcome agnostic, I say.
So as we kind of like close here, maybe as we just go through that 7-step process,
Yep,
what's the timeline? How long does this
yep,
typically take from
yep.
start to finish? And I know each case is different, and I've worked on a few of these cases with you,
Yes.
but like, what's just the timeline?
The timeline for most owners and I get this question from owners before we begin. I would say realistically, once we identify the owner's objective, their timetable, what their capital need is, the development of the plan and bringing it together and building out the action checklist can be anything from, I would say, 6 months at the
Mm-hmm.
short end to, 12 to 16, depending upon the
Sure.
availability of the owner and
Sure.
his or her advisors. And by the way, you did mention, that we've worked a couple of joint cases in a number of them over the years. I found your expertise, Brian, as a partner, as a team member in those joint cases superior to anyone that I had ever worked with in the past. And that's why, we have an independent relationship,
Mm-hmm.
which I'm proud to also contribute to this podcast and to whoever's listening. I mean, I told you with one case that we worked with, I've never seen someone
Yeah.
with the Excel capability that you have had. And I
Oh
thought I
yeah.
was pretty good. I thought I
Oh
was pretty good until I
yeah.
saw yours, which was again
I
fabulous.
could nerd out on
So,
Excel.
so your
Yeah, thank you. I mean, I
expert,
think that's just true. Like who we serve, or eWealth, our target. We love working with business owners. We understand business ownership complexity, and that's why I think it's important that we understand this 7-step process.
yeah,
I also know that we can't own that 7-step process and pretend like we can do great work because there's
right,
people like yourself and
right,
really in this area in the Twin Cities, and I know you work with people all
right,
over the US, but like
right.
you are like the celebrity in town. You have done a number of engagements and presentations on this topic and a few of these other topics that we will have you back on. I think that
Yes,
employee retention one is a great one. But anything else
yeah,
with the 7-step process to
yeah,
highlight or anything else that we want to touch on before we close here?
yeah. Thank you. Because there he is. The one thing that I guess that I would want to wrap up our discussion, and gosh knows we could go on and on, but for the benefit of you and your listeners, we will wrap it up. I will say this is that the 7-step process, exit planning, is not an event. It
Sure.
is, in fact, a process. It's a marathon. It's not a
Yeah.
sprint. Exit
Yeah.
planning is basically about helping business owners take control of the process, become educated on what their options are so that they can make more informed decisions in order to formulate a plan, ideally well in advance of their departure. And by that, I mean 3 to 5 years, so that they can experience a successful exit plan.
Hmm.
And what is that? A successful exit plan is for an owner to be able to transition when they want,
Huh.
to whom they want, and for the dollars that they deserve.
And your process, that process will solve all of those,
Absolutely.
identify
With
all
the
those.
other
Yeah.
team members, including
Right.
yourself, the CPA, and the attorney. I
Right.
simply direct the process.
Sure. And I should probably say, maybe not always solve because it may not be solved within that process, but we'll identify all of
Yes.
those.
Yeah, absolutely.
Mm. Okay. Anything else come to mind before we close here, Dyanne?
I don't think so. Like I say, I appreciate the opportunity, Brian, to be able to share this area. As you can tell, it certainly is one of passion for me, and I so much enjoy working with a diverse group of owners. And quite frankly, between myself and individuals like yourself, we have helped many owners to identify
Hmm.
what their options are and end up with a successful exit. And really taking you got one chance to monetize your life's work. Surrounding yourself with expertise is critical.
Hmm. Yeah, we'll put your contact information in the show notes, and how they can reach out and find you on your
Excellent.
website. And I know you do a lot of presenting. I think you're presenting later this week, and you present to a lot of different groups and Vistage and whatnot. So thank you for carving out some time with us today. And Dyanne Ross-Hanson, we appreciate you being such a valuable resource to our audience.
Thank you, Brian. You make it a good one.
I will. Thanks, Diane.